Good morning. For Traders Exclusive, this is George Kachuk, or RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Well, here we are, last few days in August, and I'd like to talk about the equity markets. Equity markets basically have been pretty flat for the whole month of August. S&P just tiny incremental gains, NASDAQ a little bit better, and the small caps has actually outperformed. Now, what I'd like to do is take a step back because we got this sort of like low volatility market. Everyone's saying, oh, the market must have topped out. It can't go any higher. It's not moving anywhere. Well, there's no saying in the markets. The markets will either scare you out or wear you out. And we look back at June, the market was probably scaring everybody out. And we got that sharp bounce at the end of June off the Brexit low. The last Brexit shakeout, it was volatile to the upside. And people are saying, oh, again, this is too crazy. And now with the market with no volatility going flat, people don't like that either. The whole funny thing is it's either going to scare you out or wear you out, and you shouldn't pay that much attention to it. But let's take a look underneath the hood, what's going on. Actually, the markets are acting very constructively. We're seeing some good rotation out of the utility sector and dividend-paying stocks into more aggressive growth stocks, like we talked about the last few weeks. Technology, XLK, leading the charge as industrials, XLI, semiconductors doing well. And now what we're seeing too is a good rotation into financials. This started about 3 weeks ago, and we got the July non-farm payrolls. Again, big number. I believe it was about 255,000. Followed up the June number. It was also way over 200,000. So they took that as a clue that perhaps the Fed will start raising rates, and it's a good thing for financial stocks. We'll get a little bit more clarity on that this Friday when the August non-farm payrolls get reported. Now, last Friday, the Fed reported from Jackson Hole, and they indicated that they're more likely to raise rates. And again, we saw financials jump. So if you're looking for put new money to use, that's one sector you want to start looking at is banks, regional banks. The XLF is acting very strong. I mean, it's off its highs, but in terms of something that's turning up, that's the one sector you might want to take a look at. Now, some people tell you they'll get scared if Fed raises rates. The Fed can raise rates multiple times and they'll still not be tight. They're extremely accommodative. If we look at where the Fed funds rate is compared to where nominal GDP is, that's GDP plus the rate of inflation, which is closer to 3.3, 3.5%. The Fed fund rates is around a quarter point. They can have a lot of room to raise, and they will not be tight. Furthermore, when they raise rates, they're not going to subtract anything from that $2.25 trillion that's held in reserve. So there's still going to be a lot of liquidity in the market. So kind of got to ignore the financial press when they tell you that the Fed's going to destroy the market, that the market just went up on QE, etc. Markets are doing good because companies are doing good. So, in summary, in this market, you might want to take a look at financials, and always let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago.